Hello, everyone, and welcome to U-Nique Accounting. My name is Matt Cincerello, and I'm an owner and managing partner here. You can learn more about what we do by visiting our website at www.u-niqueaccounting.com. And while you're there, I recommend you check out our blog page and also our downloadable content where you can take advantage of some free guidebooks. Also, if you're wondering what I'm drinking today, today's beverage of choice is a Strawberry Glow kombucha. It is not my favorite flavor, and I won't get it again, but if you like it, to each their own. It is Friday, so cheers, happy Friday. Also, if you notice my cup, it does bear the hashtag Make Today Count. This is a slogan for my Best Friends Foundation, which is a close and personal not-for-profit that I'm a board member of. A link will be provided at the end of this video to a form that you can fill out if you or someone you know is dealing with the impact of cancer in their life. So let's go ahead and jump into today's topic. Today's topic is why you need tax planning. Did I pay more than I should have? This is the one question that just racks the brains of every business owner every April 15th. Did I just pay more tax than I should have? Because they really don't know. The reason why this is important is that your working capital reserves are essential to keeping your business running without any hiccups. And if you overpay your tax, you're essentially stealing cash away from your business operations to cover its needs like payroll and normal business expenses. So what is tax planning? What tax planning is, it's essentially an extension of your organization's forecast, particularly looking at the tax side of the forecasted earnings. And a tax plan will build strategies to lower your overall tax implication and keep more money in your pocket. Ideally, a strong tax plan will serve as a guide throughout the year, helping you make the right financial decisions. So here are some elements of a good tax plan. There's more, but here's the ones that we'd like to include. Profit sharing contributions to your 401k, maximizing available tax deductions, maximizing available tax credits, the type of accounting method you file your return on, and the type of business entity you file your taxes as. So let's talk about the 401k and profit sharing. Did you know that in 2021, you as a business owner could have maxed out your 401k at $58,000 for the year? That's right, $58,000. And for 2022, this number jumps up to $61,000. And the reason why it's important to do is that most business owners rely on the sale of their business for their retirement needs. But doing these massive 401k profit sharing contributions on an annual basis helps put extra money away for retirement, so you don't only have to rely on the sale of your business. And another key element to this tax strategy is that hopefully if you're maxing out these type of figures, it's because you're also making lots of money. And if you're making lots of money, you're probably in the 30 to 50% tax bracket looking at your federal and state taxes. So if you can contribute money to your 401k, you're going to save today 30 to 50 cents on every one of those dollars you contribute. And the key is that hopefully when you retire, maybe you're only in the 10 to 20% tax bracket range. And so you're permanently going to save money on those contributions. And one of the keys to this plan is that even if you are a cash basis tax filer, you can still report the profit sharing contribution, but you don't have to pay it until you file your tax return. So if you want to extend your tax return and file in September, you can make the payment in September and still get a deduction for the prior tax year. Another element of the tax plan is maximizing available tax deductions. Your accountant should work with you to let you know where you spend your money and how it affects your taxes. Laws change every year on what's deductible. We still get clients that are spending money in entertainment areas, like going to a baseball game and buying tickets and golfing, and they still think they're getting a deduction for it. And we always have to let them know,
we're sorry that your prior accountant didn't inform you. Back in 2017, the Trump tax reform changed a lot of the deductions.
And they changed it so that things like the golf outing, tickets to a sporting event, and a plethora of other things are no longer deductible. Prior to it, you got a 50% deduction, but now it's zero. Another area to look at is maximizing available tax credits. So while deductions will save you a percentage for every dollar you spend, a good tax credit can provide a one-for-one tax reduction. There's a link at the end of this video where you can download our free tax credit guide to see some common credits that are available. Let's talk about your choice of accounting method. So when you first filed your tax return, you had a choice. Do I want to be a cash basis taxpayer or an accrual basis taxpayer? An accrual method is you're going to report your revenues when earned and expenses when incurred. Whereas a cash basis taxpayer, you're going to report revenue when you receive it and expenses when you pay for them. There's also in the construction industry the completed contract method, where even if you've received money and you spent money in a project, you can delay reporting all the profitability in a project until it is actually finished. When you first started your business, you may have chosen an accrual basis because maybe you were getting a lot of customer deposits back then. And there's no point to file cash basis and to pay taxes on customer deposits. Well, go forward, so maybe your business model has changed now, and it would make more sense to file as a cash basis taxpayer. But luckily, this was another element of the 2017 Trump tax reform. There used to be limitations on who qualified to be a cash basis taxpayer in terms of revenue size and some inventory measurements. But basically, if you were over $10 million in size, you had to be an accrual basis taxpayer. Well, that limitation got changed to be $25 million. So there's a lot of clients who are in those $10 to $25 million thresholds who now have the choice to go back to being a cash basis tax filer. Another element of the tax plan is the type of entity you chose to be. So there's a few ones we want to talk about. There's the S Corp, which is the most preferred by accountants and tax efficient. There's the LLC, which provides the most flexibility on how things are shared amongst ownership. And then there's the C Corp, which does have double taxation issues, but it can be the most tax efficient based upon the exit strategy of your business. To recap, what does tax planning provide? It should provide more money and thus increase cash flow to your business. It also should give you better decision making. Should you buy that car or should you not buy that car? And most importantly, when you file your tax return, no tax surprises. So thanks for listening to Why You Need Tax Planning. If you appreciate our advice, please remember to like our video and subscribe to our channel for future content. Until then, remember, don't conform, stay unique.